Good afternoon, everyone, and thank you for joining us today for our fourth and final spring lunch session. Today's topic is about detecting financial health, and more specifically, what signs to look for in an organization's financial health. My name is Stephanie Griffin, and I am the admissions officer for the EMBA program at RIT. Two quick notes before I turn it over to Program Director Marty Lawler for an introduction to today's speaker, Dr. Ashok Robin, who you see on the video screen there. First note is that this session is being recorded and we will make it available later on. And second, if you have any questions throughout the half an hour, please type them in the Q&A box at the lower left corner of the screen, and we'll try to get to them during this session. If we don't get to them during that time frame, we will follow up with you afterwards. Okay, so that we can get right to the presentation, I will go ahead and turn it over to you, Marty.
Thanks, Stephanie. I also would like to welcome everybody to today's webinar. As Stephanie mentioned, this is the final webinar of 4 that we've done this spring. We started with a webinar on data analytics from Professor Vic Parati. We did an interesting panel on women in business with several alumni of our program and Professor Sandra Rothenberg. We did a really interesting webinar on product commercialization with Professor Bob Boehner. And now we're very excited to have Professor Robin, Ashok Robin, doing one on finance. Finance is one of these courses that has a reputation for maybe being somewhat difficult to comprehend. Students sort of approach finance and other more quantitative type courses with some trepidation sometimes. And I'm happy to say that Ashok is a especially highly regarded professor in our online EMBA program, in our on-site EMBA program, in several other graduate programs as well. And I believe really has a gift for communicating complex notions in a very clear fashion. So I think we're lucky to have him here. His short bio is up here. I'll let you read it on your own, except to say that he's fellow at the Center for International Business. He's authored a textbook on international finance, and just a very well-regarded member of our college. So with that, Ashok, I think I'm going to just pass it on to you and let you start, and then I'll jump in later, probably toward the end of this.
Thanks, Marty. All right. Good afternoon, everyone. I'm going to talk about detecting financial performance or detecting financial health of businesses. And my focus here is actually on public companies because they are required to publish financial statements every quarter. And that's the basis by which I'm going to look at the data and show you how to assess performance. But the same techniques can also be used for private companies which are not required to publish this information. But if you are privy to that information as a banker or as a consultant or whatever, then perhaps you can apply the same principles there also. So first, very briefly, why conduct such an analysis, who would conduct it, and how? Okay. So various parties are interested in detecting financial performance or financial health. If you think about bankers dealing with a company, it could be other suppliers, customers who are also interested in knowing whether they're dealing with a sound partner. It could even be employees who are interested to know whether they're working for a sound company or not. Okay. So we have various parties who are interested in doing this. Why are they doing this? Because they have a financial interest in the welfare and future of the corporation. So if you're a supplier, you probably want to have a 5-10 year horizon dealing with the corporation. So you want to know that the company is sound in that horizon. And how exactly would you conduct this analysis? Well, there are many sources of information on a business entity, and I'm going to focus just on financial statement analysis. It's one way to understand the health of the company. And it's a very powerful way to understand the health, as you'll probably see very soon in this presentation. Before I can proceed any further, very quickly, the language that we use in finance, perhaps this is new to you, and let's see if I can simplify the language and put a few terms in front of you that we can repeatedly rely on to proceed with our narrative. Okay. Firms sell products and services. That's the reason for being for a corporation, and that produces revenues. They incur various costs, and those are categorized as expenses. And if you subtract expenses from revenues, you have profits, also called net income. And I think this is something that most people would know. The financial infrastructure, in other words, in order to do all of these things, what is the infrastructure necessary for it? Basically, these are assets. A corporation holds lots of assets. And these assets, where do you get the money for it? From investors. Okay, so we have financing coming from various sources, financing that plows into these assets, which then produce profits and cash flows. Okay, and assets have various categories. You don't need to know a whole lot to understand, at least at a fairly interesting and basic level, what's going on within a corporation. Okay, and financing items can be either debt or equity. Okay, so here is the main theme here. Okay, and this is the what I call the financial narrative. Okay, so I'm looking at what is the story? What is the story behind a business? The story concerns the following elements. It concerns the cash flow generated. In other words, the amount of monies that are generated through running the business, through operations. Operations, same thing as saying running the business. Okay, and you generate these cash flows, and what do you do with it? You allocate that, use it towards renewing assets. Every business has to renew itself frequently. You have to service debt, because servicing means you need to make payments. Like in a credit, if you have a credit card, you're making payments, right? Same thing for a corporation. And rewarding shareholders. They are the ones who invested monies in the corporation, so you have to reward them too. So this is the financial narrative, and this is what we can look at this narrative through the prism of the financial information that firms are revealing, and then we can say, okay, so is this narrative, does it make sense? Is it sound? Or maybe it doesn't make sense. Maybe they are not doing certain things properly. So this is a story that we'll test against the data that we observe. So some specifics about today's presentations. Basically, taking a quick look at the financial information that firms reveal, and firms reveal three important statements. They reveal an income statement, which is an accounting on what revenues they get, what expenses, what incomes, and a balance sheet, which is basically it's an inventory. What do they have? Okay, what assets do they have and how they financed it? So that's a balance sheet. And then the statement of cash flows, and I italicized it because that's really our focus. That's where the narrative, the financial narrative, can be found in the statement of cash flows. Okay. Examples of things that we can learn. Okay, so what are kind of inferences which we can obtain from by testing this narrative against the information, financial information. So at a very basic level, we can understand what are profits, what are margins, how robust are cash flows arising from the core business, and how does the firm use its cash flows? Is it paying a big chunk of money to its bankers, or is it paying a big chunk to its shareholders? Is it expanding? And in the course of doing so, we can also get some clues as to what kind of a firm we have. I mean, I think that for financial professionals, even if you don't say a single word, if you simply show a financial statement, you can immediately understand, okay, what kind of a firm we have. Is it a young firm? Is it a growing firm? Is it a mature firm? Is it troubled? All of that can be detected very quickly by looking at financial numbers. Okay. So the purpose of today's presentation, of course, I can't teach an entire course worth of information here. It's just to give you a little taste of what it means to be a financial detective. I think it's fun to think of ourselves as detectives, as a financial detective, to understand what is going on by looking at the information that is given. Okay. Okay, so again, not to try to understand everything in front of you, I just wanted you to take a quick look at an income statement. You know, this is a typical format, and actually downloaded this from Yahoo Finance, but it's available in various sources. You know, you start with revenues. What did you sell? You deduct various expenses, and then you end up with net income. Now, pretty much any person would understand the kind of information that is revealed in this. So I call this the obvious information. Okay. Now, here is what is not so obvious, and I think that's the focus of today's discussion, the statement of cash flows. So this is a financial narrative, meaning what is the cash flow that is generated by the business, and that's called the operating cash flow. So, for instance, if you take a look here, for the year 2014, this particular firm, Boeing Corporation, generated roughly $9 billion of operating cash flow. So that's the beginning, the one element of the financial narrative. And then what did it do with it? Okay, so the same corporation, it made a little more than $2 billion of capital expenditure. So that's renewing the assets of the corporation. Okay. So basically, the financial narrative can be understood by looking at the cash flow statement. I'm not going to go through every number here. I just want to quickly tell you a few things. It, for instance, paid dividends of about of $2 billion. It bought back its own equity for nearly $6 billion, etc. So we understand the financial narrative here. Okay, let me move on to some specific examples of things you can understand. Okay, so let's talk about restructuring firms. We hear a lot of talk in the financial press about restructuring firms, the firms that are reconfiguring their businesses, that are moving in and out of various types of operations. Okay, so that they are called restructuring firms. So how do we understand a firm is restructuring? By looking at financial numbers. Well, you can take a look at capital expenditures. Okay, so that'll give you a clue about investments made by the firm in new businesses. But more importantly, you can take a look at a category called investments. Okay, when a firm sells assets, and that's typically what happens when you restructure, you're getting rid of assets, and that's a perfectly normal and healthy activity by corporations. You would find some positive cash flows, under investment. In other words, money is coming in, they're getting rid of stuff, and therefore money is coming in. Okay, so a restructuring firm is going to have both capital expenditures, money going out, and investments being positive, being money coming in. Okay, if you're a struggling firm, you're basically decreasing capital expenditure. Okay, you don't have money, so therefore you don't expend. But a restructuring firm also sells assets, so money is coming in, so that'll be a nice clue. So here is an interesting example. I actually have a couple of examples of this. So this is the ticker symbol OMG. It's OM Group. It's a specialty chemicals company out of Cleveland, mid-cap, smallish to mid-cap company. Okay, so it is restructuring, right? So the key here is to look at, let me get the pointer, capital expenditures. So there are some capital expenditures. Also, the pattern, however, is not great, because 2012 it has 67 million of expenditures, and it's expending less in 2013 and 14. I think the company is constrained a little bit, so this also may be a cause for concern. But here is an interesting number. In 2013, we have a huge positive number, 300 and almost $400 million money coming in. It's a positive number. So this company has been restructuring its asset base. And actually, I went to the annual report of the corporation for the year 2013, and here are some excerpts. Okay, so this is I'm basically telling you what the company is telling us in the annual report. divesting a commodity cobalt and ultra pure chemicals business for a combined 392 million in net cash proceeds. 392 million, that's what they're reporting. It's showing up as a little different here, but same ballpark, close to 400 million dollars. Okay. They also say repaying all of our outstanding debt, which enabled us to end the year with 118 million in cash, etc. Okay, so they got a big chunk of money. They also used that to repay their debt, and that will also show up here. So look here, there is a big negative number under borrowing. Okay, so money is going out. So they used sale of assets to get rid of debt and restructure the company operationally and financially also. So this is one interesting example. Okay. Another example, this is a company you may have heard of. It's Dow Chemicals, um, a large company. I think it's even part of the Dow Jones Industrial Average, and it's in much better financial health than the previous company that I showed, OMG. And you can simply see that even in the fact that they are indeed ramping up capital expenditures, so they are optimistic and opportunistic concerning the future, ramping up expenditure. And this company, like in the previous example, we once again see large positive values under investments or investing activities. Okay, so for instance, 536 million in 2014 and 691 or 681 million in 2013 represent large divestitures. They are getting rid of assets. And once again, when I go to the financial report for 2013, so here is what I find. Okay, upon the completion of our chlorine and related commodity businesses, we have divested more than 14 billion in annual revenue since 2019. So they're talking about how much revenue what haircut in revenue that they got by getting rid of these assets. So they've been on this journey since 2009. And what is particularly interesting is the origins of this company was actually in the chlorine business long time ago, and they're actually getting rid of the chlorine business. So you can't be tied to any particular set of operations, as you can see with successful companies like Dow Chemicals. Okay, so they also go on to say, during the same period, we have added 18 billion of value-added businesses through acquisitions and organic growth. Okay, so once again, they refer to how much revenues they got from these new businesses, $18 billion of revenues. Okay, so renewing the business, getting rid of stuff, it's like pruning a tree or pruning a bush in spring. You get rid of stuff, new growth comes in. That's basically the story of these corporations. Okay. Other interesting things, dividends. They're paying healthy dividends. They are repurchasing shares, so they're rewarding shareholders by allocating cash towards the shareholders also. So interesting example of restructuring and staying healthy. Okay. So we talked about two examples of restructuring corporations. So let me move on quickly to the second type of an example. How do growth companies look? Okay, so these are typically young companies that are growing. It can also be mature. Apple Corporation is going through a phenomenal growth phase right now, but that's not your typical profile of a growth company. Typically, it's a small company that's ramping up its business. Okay, so during the growth phase, you have a dramatic rise in revenues. In fact, companies focus just on revenues. They don't even care about controlling cost, etc. Let's increase revenues. So what else can we observe? Financially, what else can be observed, and what are some of the indicators? What are some troublesome items? What are some hopeful items? So let's take a look at a growth firm. Okay, so this is a restaurant chain. I think it's mostly in the south. I don't think I've seen it in Rochester. Maybe you've seen it in the location you are in. Zoe's Kitchen, ticker symbol ZOES. Okay. So what do we see here that tells you that it's a growing company? Okay, so some interesting indicators. Negative net income. It's not earning profits. That's fairly normal for young and growing companies. Okay, I'm not showing here revenues. If you go to see the revenues, you'll see that revenues are growing, so that's in a different statement. Okay, you also see ramping up of capital expenditures. It's investing in new restaurants, new properties, new equipment, etc. Okay, so you can see the ramping up from 2012, 2013, 2014, from 15 million to 28 million to 32 million. Quick ramp up of the business. Okay. Other investments, again, there is a negative, meaning again investments, money going out, roughly $9 billion in 2014. Okay. Now, if you're young and if you're growing, um, especially if you are sound, okay, and this appears to be a fairly sound business. Actually, they manage to bring in 91 $91 million of equity. Okay, so actually when I went to the annual report, I found out that they actually had an IPO, initial public offering. So only they've been trading in markets only in the past year. Okay, they had an IPO at $15, and as you can see at the top of the screen here, at the time I made the slide, the stock price was not 15 but almost $34. So a company in considered to be in good shape. Okay, so what did I find in the 2014 annual report? On April 16, 2014, so that's very recent, right? So last year, we completed our IPO, initial public offering, first time you issue stocks in the market of so many million shares at $15 per share. They used the proceeds to repay the entire amount of then outstanding borrowings. Okay, so they had some loans that they repaid, and they used the remainder of the proceeds to support our growth primarily through opening new restaurants and for working capital and general corporate expenses. Okay, so I think it's at least to me, after having seen a few thousand of these statements, I don't need any narrative. I can just look at the statement. I can tell you very quickly it's a growing company. Okay. Okay, how do precarious borrowers look like? What kind of trouble they can get into, and so on. So here the key is to look at the size of the operating cash flows and relating to the debt service flows. Okay, so I need to speed up a little so that I have time for any questions. Okay, so here is an example of a company in a little bit of bad shape, Pep Boys. Okay, I think again company that you may have heard about. Okay, net income decreasing year over year the last 3 years. Okay, and notice that they are making large debt service payments, meaning interest, principal repayments. These values are high compared to the net income or compared to the operating cash flow, right? So this company is constrained, and you can see the constraint in the fact that it's perhaps not investing as much as it should in renewing its stores and its business. So by comparing the relative size of these numbers, we can make some interesting inferences. Okay, and finally, okay, I'll just show you one example of a very happy looking company. It's a cash machine. There are some companies that are cash machines, and this is one particular cash machine. This is an interesting corporation, Apple Corporation, the world's most valuable company. Notice that it's generating about $60 billion of operating cash flows. The entire country of Greece can be supported by this company. Okay. It's investing tremendous sums of money in capital expenditures, in various investments, roughly $20 billion being invested. So in a case like this, the concern is mostly related to, is it using its cash wisely? It's got tons of cash. Is it using it wisely? Okay, so that will be a concern for investors. Okay, so I think I have come to the end of the presentation, and this might be a time to see if there are any questions that are coming out at this point. Let me just pause
Yes, sure.
a brief moment.
Here, one question that we have is, are there specific financial issues facing young or mature companies?
Okay, so the question is, are there any specific issues facing young companies? For a young company, the key is, I mean, it's trying to grow rapidly. It's trying to build its assets base rapidly to keep up with the growth in sales. So it is fundamental concern is really, has it lined up financing? For instance, we saw in Zoe's Kitchen, it went to the equity markets. And the reason it went to the equity markets is there was no way it can go back to the banker again and ask for more debt. You can't keep getting more and more debt. You need to go to the equity markets. And equity markets are very tough. They are a tough nut to crack. So they'll be looking at you very closely to see if you set up your business properly before they would commit capital to you. So the key issue in a nutshell is whether you have the fuel for growth, which is money. Okay.
Okay, another question we have is, these young companies don't make money initially. How long will shareholders wait before they want to see profits?
Okay, great question. How long will shareholders or creditors wait before the profit shows up? Actually, there are some interesting cases. If you look at Tesla Motors, still not making money. Netflix not making money. Netflix actually is an amazingly large business, and it's still not. Maybe it's making a little bit of profits. It's still investing in the infrastructure. I guess you need a good story. You need a good financial story. You need a good strategic story, good business story. Like in the case of Netflix, they have something like 200 million subscribers. So now the question is, how can you monetize those 200 million subscribers? So management is desperately sending its narrative, its business narrative out to the world to convince investors to stay the course to keep money. The moment investors lose faith, that's it, right? They pull out, stock price goes down, bankers don't give you any money, you have no oxygen to breathe. Okay.
Another
The
question is,
question for, yeah, go ahead.
if a struggling company becomes a target of an acquirer, what kinds of financial things does the acquiring firm do to restructure?
Okay, so sometimes a struggling company is unable to take the steps that it needs to take because it's committed to things. It's committed to certain management teams, certain ideas, certain assets. There is a commitment there, and it's tough to, remember I talked about Dow Chemical getting rid of the chlorine assets, which is what started the business, the whole company. So you have this deep commitment, and it's very hard to get out of that. So sometimes what it takes is an external force, an acquirer or a activist investor like a Carl Icahn to come in and exert control over the corporation to in order to get rid of those underperforming assets, to make the investments in new assets. So acquirers look for any inefficiencies in how you're running the business, and whether they can remedy the situation, and that's why they would come in. And of course, if you're an incumbent manager, you hate it. You would hate new bosses coming and telling you what to do.
Excellent. Well, I think before we move on to any more questions at this time, do you have any key takeaways? I think you have a slide on key takeaways,
Okay,
and then we'll close it out so that we can end on time.
Okay, so here are some quick thoughts, final thoughts. The key, as always, is operating cash flows. It drives value. You have to have healthy operating cash flow. There's no such thing as running a business long term without operating cash flows. Okay, that's your core value generator. But how do you generate operating cash flows? You need investments. You need to renew assets, make investments in appropriate assets. Okay, so you look at operating cash flows, you look at investments. And shareholders demand a piece of the action. Okay, you can't keep them at bay for too long. So you would see that in the dividends that firms pay out, in the share repurchases that firms pay out. Of course, if you're a young company like Zoe's, you're not doing either of these activities. But down the line, when you have healthy cash flows, like an Apple Corporation, healthy cash flows, shareholders do demand it. Okay. A healthy firm balances various elements. Okay, so it's a juggling game. How much do you invest? How much do you pay back to your investors? Okay, how much do you get rid of? So it's a juggling game, and that's where the beauty is, and that's why they pay those big bucks to CEOs and CFOs to take care of businesses. Okay. constrained firms, if you're really constrained, you're not in making the investments, you have these deficits, but you should never confuse a young firm like Zoe's Kitchen. It's a young firm making investments with a tired firm that's running out of ideas and not knowing what to do. So these are some of the takeaways from this brief presentation. I hope you got a few pointers and you enjoyed a few things.
Ashok, well, I want to thank you very much for taking some time to talk about this topic. As Marty mentioned earlier, finance is usually one of those topics that people who do not work directly in that field feel the most unease about before joining a program like this. But you find a way to break it down and make it manageable and meaningful, and there's always a lot of good feedback in your courses. So thank you again for taking the time today.
You're most
We
welcome.
have we have two starts a year for this program, August and January, and just for the guests in the session, for the upcoming August class, the application date is coming up. It's about 7 weeks away in July 1st. But what we'll do on this last slide here is provide contact information for both myself if you have any questions on the program, or if you have any questions on the information that you saw today or anything that Ashok talked about. His information is here as well. So thank you for providing that, Ashok. And if you have any questions, feel free to reach out to him. As Marty mentioned, there were 3 other sessions that we did this spring. We do have the recordings for those, and they were all on different topics that we touch upon in the program and very useful. So at the end, when I turn the screen next here, you'll see the links that you can get those recordings if you're interested. So at this time, I just want to say thank you again for joining us, and hopefully we'll talk to you soon and enjoy your day.